Releasing another interest rate increase at the 0.75 of a percentage point. This is the fifth time the Fed has raised rates this year.
While most of us think of higher interest rates as a monster and a destroyer of our economy, it is quite the opposite. Contrary to popular belief, the higher the interest rates are, the lower the inflation is. This might come to you as a surprise, but this is the actual truth not many people are aware of. The Fed has again increased the interest rate by 0.75% to combat inflation and slow down price increases. While few people are happy with the decision, the Fed has something else in mind. It may not be apparent on the outside, but the department seeks to slow the economy and bring prices back down through this step. How exactly will this happen? Let's see. Most of us are familiar with the term interest rate. It can be defined as the cost of borrowing. America's central bank, the Federal Reserve, controls this rate. The Fed itself determines whether it needs to soar or plunge this rate, as per requirement. Commercial banks depend on it for some of their most important banking requirements, such as maintaining deposit accounts. For most American banks, however, there is a minimum reserve threshold they should always maintain. If a bank's reserve drops below this set amount, it must borrow from other banks. For this, they are also charged with interest rates, like all of us. The interest rates that the Federal Reserve sets. But how does this rate, that has no direct connection to the economy, affect it so much? While it may seem like it, this is not actually the case. The interest rate has a huge role in our lives directly. This is why it influences the economy so much. You go to the bank for a loan whenever you fancy buying something big, such as a house or an expensive vehicle. If, suppose, at the time the interest rates are high, banks charge customers a higher rate too. In addition, if the federal fund rate is increased, it is possible that your credit card's annual percentage rate, APR for short, and your annual percentage yield, or APY, on your savings account would increase as a result. Consumers who hold revolving debt on their credit card may find that the interest costs that appear on their monthly account are greater if this scenario plays out. Those currently carrying a balance on their credit cards might want to look into opening a new credit card account with a company that provides an introductory period of 0% interest on new purchases or balance transfers to assist them in making it through the rough patch. The prime rate is the finest illustration of this phenomenon. The prime rate, for those who don't know, is the interest rate that banks impose on their most creditworthy clients, such as big businesses. The general consensus is that the prime rate has been equal to the federal funds rate plus 3% for several decades. The new prime rate would therefore be at the upper range of 5.5%, with the new federal funds target rate between 2.25% and 2.5%. The percentage discrepancy is meant to compensate for the processing fees for bank loans. Changes in the prime rate consequently increase borrowing costs for all other loan products, including revolving debt like credit cards, real estate, and auto loans. According to the notion, people will be forced to spend less if this happens. It is because, in this case, borrowing money or carrying debt on a credit card will become more expensive. Businesses are also affected by this, reducing the amount of money they borrow and invest due to higher interest rates. This would mean that both consumers and businesses would begin spending less money, eventually bringing demand back down to a level proportional to supply. Wasn't this the ultimate goal in the first place? However, as per economists, there is also a significant chance that the combination of increasing borrowing costs, high inflation, and weaker growth could push the American economy into a downturn. How? Well, the increased interest rates have their fair share of problems too. While many catastrophic effects can result from the higher interest rates, in the worst cases, it forces the economy into a recession. This is probably the most threatening thing for an economy in the world, especially for one that is already struggling. If the rates continue rising in the long run in response to customers purchasing fewer goods and services, firms may choose to reduce production as well. If even this does not work, they may also reduce the number of inputs and labor they use. Therefore, the Federal Reserve must choose its actions wisely. Jerome Powell, the head of the Federal Reserve, has stated that he wants to match supply and demand more closely. But over the epidemic, the worldwide supply chain for a wide range of products has been severely constricted, partly because of China's tight COVID-19 regulations, from which many mass-produced commodities are obtained. Although with the natural gas and crude oil supplies that Europe mostly depends on, the prolonged conflict in Ukraine has also had a detrimental impact on the world's food supply. Therefore, the Federal Reserve is not pushing it too much. For now, it may be limited in what it can achieve with the tools at its disposal. This brings us to the end of this video. If you liked the video, please consider subscribing and sharing so we can keep bringing more content like this. Also, let us know your thoughts in the comments below. See you next time!